Hello, everybody. Welcome to our webcast that we're having on our ASU 2020-07, which is our presentation and disclosures by non-for-profit entities for contributed non-financial assets. I'd like to get started with introducing our presenters for today. So we have Sue Cosper, who's our FASB board member, Jeff Mechanic, who is the FASB Assistant Director for Non-Public Entities. We have myself, who is the FASB Supervising Project Manager on this project. And we also have Rachel Daniel, who is our one of our postgraduate technical assistant, and Stephen Whitman as well, who is our postgraduate technical assistant. And everybody had a big part in helping with today's materials, so those will be our speakers. So just wanted to touch base on a couple of housekeeping items before we get started. So the slides can be downloaded by clicking on the left-hand side of clicking on the Event Resources tab. And if you want to ask a question, you can type into the Ask a Question box on the left side of your screen and click Send. And just remember to turn off your pop-up blockers. So in terms of the webcast, we will have this recording available online at fasb.org after this is over. CPE will not be available to those who will be watching the archive program. And if you do have any questions about this webcast or any other educational materials, you can contact the FASB at cpedirector@fasb.org. At the end of the presentation, we will touch a little bit upon where you can find some implementation materials as well on this webcast. So just a reminder, so CPE is available for the viewing. Today's webcast will be worth about 1.5 CPE credits. And again, as I mentioned earlier, it is not going to be available for viewing this afterwards. And to receive your credit, you must stay on the webcast for the required number of minutes and also respond to the polling questions that we have throughout the webcast. So in terms of learning objectives for this session today, we are going to provide an overview of the presentation and disclosure requirements for gifts in kind, and just include some practical applications of the guidance. We're going to have some illustrations as well to help demonstrate some of the various ways that you can apply the guidance. We also are going to go through the transition and effective date requirements and touch a little bit upon some of the application questions that we've been getting around how to determine the fair value of gifts in kind. And then last, as I mentioned, that we will have a slide at the end about the implementation resources that are available. So just about a little bit of an overview of what we will be discussing today. So we'll start off with our webcast agenda, which is why the board issued the ASU, and just give a little bit around the overview of it. Then we'll get into some of the details of the presentation and disclosure requirements themselves with some illustrations. And last, we will get into the fair value considerations for gifts in kind. And we will have some question and answer session at the end, but feel free to ask questions throughout the presentation as we go. And so with that, I think we can start off with our first polling question, which is, which of the following best describes the organization that you work for? Is it A, a local CPA firm, B, a regional or national or international CPA firm, C, a not-for-profit organization, D, a grantor, lender, regulator, or other user of financial statements, and E, we have other. So I think that we just give a couple minutes, a couple seconds to show the results of that. And my screen is not showing the results. Okay, great. So it looks like we have, I think we can go ahead and send the results to the audience now. So it looks like we have a lot of people from CPA firms, which is great. And then we also have a lot of not-for-profit organizations, which is what I think we would have expected. And then we do have some other and some, looks like we have a little bit of everybody on this. So that's great. So with that, I think we can move on to our first section, which is overview of the ASU and why we issued it. And so I'll turn it over to Sue Casper to go through those slides.
Thanks, Liz. As Liz said, I'm just going to do a brief kickoff for us on just providing you a bit of an overview. So we issued ASU 2020-07 last September. Its intent is to make the reporting of gifts in kind received by a not-for-profit more transparent in the organization's financial statements through enhancements to presentation and disclosure, especially those gifts in kinds that an organization uses in the conduct of its programs and other activities. You'll note in the title of the ASU and in the guidance itself, we use the term contributed non-financial assets rather than gifts in kind. We do so for two reasons. First, contribution and non-financial asset are both terms that are already defined in Gaap in the codification. I'm sure most, if not all, of this particular audience already knows how Gaap defines contribution, probably word for word. But as a refresher, a contribution is an unconditional transfer of cash or other assets to an entity or a settlement or cancellation of its liabilities in a voluntary non-reciprocal transfer by another entity acting other than as an owner. Well, that is a mouthful. What's a non-financial asset? Well, basically it's an asset that isn't cash or the contractual right to receive cash. It includes the assets listed on this slide, fixed assets, use of fixed assets, materials, supplies, intangibles, and services. Services are considered assets, but ones that are typically used up simultaneously with their receipt. The other reason we use contributed non-financial assets is that we've seen an array of dictionary definitions of gifts in kind. Some as broad as all non-cash gifts, while other gifts of stocks, bonds, or other financial assets are often a key source of funding. For many not-for-profits, they're rarely, if ever, used directly in conducting programs and other activities. So moving on to the next slide, want to just say, why is transparency important for this topic? Well, in our outreach, which included the FASB's Not-for-Profit Advisory Committee, or NAC, we learned that many not-for-profits, including smaller ones, receive and use significant amounts of gifts in kinds in their programs and other activities. That, in turn, can significantly affect key metrics on which donors, grantors, watchdogs, and others assess not-for-profits. Especially noteworthy is the program expense ratio, which measures the percentage of total spending directly on fulfilling an organization's mission, as opposed to on fundraising and management and general expenses that support those programs. What originally drew us to this area were the concerns that we were hearing from state charity regulators about the valuation of certain pharmaceuticals, the impact that valuations were having on the financial statements and related metrics of some not-for-profits, and then the overall lack of transparency around that. But significant reliance on gifts in kinds can have implications well beyond program expense ratios and other metrics. It can potentially affect an organization's programmatic and financial sustainability. For example, let's say a not-for-profit typically receives a significant amount of gifts in kind each year and uses them in the delivery of its programs. Then in a particular year, for whatever reason, there's a significant decrease in the amount of gifts in kind received. Well, the not-for-profit has an important budgetary decision to make. Does it scale back the level of its programs, or does it use other resources to buy the assets it hasn't received in order to maintain the level of its programs? These choices and the ramifications for programmatic or financial sustainability are very much of interest to lenders, grantors, and many other key stakeholders. And for both of these reasons, we issued 2020-07 to seek to bring greater transparency to this area. So Liz will be getting into some of the details shortly, but moving on to slide 13, I know everyone wants to know exactly when this standard's effective. So amendments will be effective for annual periods beginning after June 15th, 2021, and interim periods and annual periods beginning after June 15th, 2022. So it'll be fiscal year 2022 for those June year ends, with interim periods in 2023. And early adoption is permitted. And in transitioning to the new standard, it will be on a retrospective basis for all periods presented. We typically, when we have presentation and disclosure improvements, we have found that the trending information is important. So the effective date initially for annual financial statements is consistent with the feedback we received on the exposure draft concerning the amount of time that not-for-profits would need to implement the standard. So the way we phased it will give you a little bit more time to prepare for the implementation. So with that, Liz, I think we're turn it back to you.
Yeah, so we're going to go through the second polling question now. What sector best describes the organization that you work for or the greatest number of organizations that you work with? A, healthcare, B, membership services, C, higher education, D, other human services, or E, other. Okay, so we'll just wait a couple seconds to get those results. And I think we also had a couple questions come in. So we did get one on, let me just read the question. In many non-for-profit gala events, non-for-profits receive gift in kind as items to be auctioned for fundraising. Can you describe how these gifts in kinds would be treated on a financial statement? Jeff, not sure if you want to take this one or if you want me to.
Again, there is guidance here, particularly I think in the AICPA audit guide, there may be some stuff in Gaap that if we're talking about amounts that are essentially monetized and for purposes of, actually, I guess these are amounts that are used for fundraising. They are typically, presented as direct donor benefits, which is an amount that goes right under the corresponding revenue that comes in from these types of gala events. And you would be doing some disclosures around this in connection with this ASU, but you'd indicate that these are used not for programmatic purposes, but for fundraising.
Jeff, there's another question that came in as well. It was a question of whether contributions of investments are not included under this. And I would just like to confirm the answer is no. Contributions of investments are, generally speaking, financial assets. So this is really only as it relates to contributed non-financial assets.
That's correct, Sue.
Thanks, Sue, and thanks, Jeff. All right, so we do have the survey results now. We pushed them out to everybody. And so looks like a lot of people are in the other bucket, but there is some other human services and then higher education and then membership services, a little bit less, and healthcare at the lowest. So again, a little bit of a mix. We're not sure what's in the other, but good results here. So let's, I think we can move on to the next couple slides, the next section here. And the next section, I'll be starting that off. And so this is just getting into some of the presentation and disclosure requirements. of the actual, kind of the meat of the actual guidance here. And just starting off on the overview of the requirements. This is just an overview of the presentation and disclosure. I'll start off with the presentation, which would be, you would have to present contributed non-financial assets as a separate line item in the statement of activities. I think a lot of companies are already doing this now, but this is an actual, separate line item. We'll get into some examples coming up. And then this would be followed by some disclosures. And, as Sue mentioned, these requirements are meant to increase transparency. Many not-for-profits are already presenting gifts in kind separately and providing at least some kind of disclosures that would be required in this update when gifts in kind are a significant component of an organization's revenue. And this ASU requirement will help to bring some consistency across the sector wherever gifts are significant. So moving on to the next slide, which really just summarizes what was on the previous slide, just giving a very high level of what the presentation requirements are, or requirement. And then we can get into some examples here. So on the next slide, here we have, this is pretty straightforward example, but we have one here where, I guess before I get into the examples, I really just want to emphasize that, the terms that we use can vary across organizations. It's not so much on the terms that we're using, but rather, I think some people call them gifts in kind. Some people just call them, they might be more specific in terms of what those gifts are. And also the presentation can be done in various ways as well. But I think at a minimum, we just want to make sure that there is a separate line item that is included in the presentation, in the statement of activities, that's separate from your cash and your other financial assets. So in this example here, you'll see that there's just really one line item here that is the gifts in kind for, $528,140. And you'll notice that as part of the revenue recognized that there were the two line items and then it has moving on to the other forms of income with the government grants and the other income and things like that. Again, the organization can choose to provide more detail or have different titles or formatting, but really at a minimum, they just have to have a separate line item presentation. We also wanted to emphasize that, the comparative presentation is required at the initial implementation going forward. So this is consistent with the general requirements of Gaap and the retrospective transition requirement. So for example, if an organization were to implement the presentation and disclosure requirements for fiscal year 2020 and has presented 2019 financial statements, they would have to present a separate line item for contributed non-financial assets for both 2019 and 2020 statement of activities. Moving on to the next slide. So of course, in terms of the presentation, I think companies need to look at their materiality just to make sure, if something is material, then they would have to separately present it just as they would in all other areas of Gaap that they would look at. And again, just want to emphasize that this is just an illustration similar to the ones that are in the ASU, not a required format or content, and there is definitely a degree of flexibility when it comes to the labeling and formatting. We have seen that in some best practices that if gifts are very material to the operation, some non-for-profits have even used a separate column that's illustrated here. And after hearing some of the feedback that we got from the NAC and some of our other key stakeholders, the staff didn't recommend to the board, and the board had also decided not to require the separate presentation of expenses associated with these of gifts in kind, or the ending inventory balances corresponding to the gifts in kind not yet used. We'd heard feedback that the tracking could be very difficult, especially in instances where a not-for-profit purchases and receives the same type of gifts in kind assets. And therefore, we focused the disclosure requirements more on qualitative information around the expense side, in addition to the quantitative and qualitative information on the revenue side. Now, having said that, if your organization or client does have the appropriate systems and processes in place to track that information, of course, they can still provide it and determine a presentation that makes sense for their organization. Another way of separating expenses for the GICs, using the GICs versus the purchase, is to do the breakout instead of a separate line item on the statement or schedule of functional expenses. In practice, we've seen a separate section of gifts in kind funded expenses after a subtotal of all other expenses. So with that, I think I can turn it over. Actually, we have another polling question. So we'll go to polling question number 3, which is non-for-profit organizations can present contributed non-financial assets in their statement of activities in which of the following ways? A, combined with contributed financial assets, B, as a separate line item, C, as a separate column, both B and C, or E, all of the above. So we'll just give a few minutes to push that out to everyone, and we can check to see if we got any other questions in the meantime. Let's see. We did get one question. I can answer this and then others can add in. The question is, why not present as non-financial asset rather than in kind as stated earlier? Again, I think, as I said on the examples, the terms really are not necessarily that, you don't have to use the standard gifts in kind wording. You can use whatever makes sense for your organization. So if you want to present it as non-financial assets received, you can do that. There is quite a bit of flexibility, so you don't have to use as we have it illustrated here.
So Liz, what you mean is the actual caption that's on the financial statements as opposed to the shorthand that we're probably using in the presentation?
That's right. That's right. It's really just the terminology. So the accounting would stay the same. You just have to determine what the wording would be to capture that line item that would best represent your facts and circumstances. Okay, great. So let's see the results now. I think the results have been sent off to the audience. So let's see here. So everyone wrote both B and C. Excuse me, D. Yeah, D, both B and C. So you would present not contributed non-financial assets as a separate line item or as a separate column. Yes, that's correct. Okay, great. So then I think we can move on to the next, to the disclosure section, and I will hand that off to Rachel, who's going to walk us through the disclosure requirements and some illustrations.
Great, thanks, Liz. So turning now to the disclosure requirements, most of these disclosures are based, at least in part, on existing best practices in the not-for-profit sector. Quantitatively, not-for-profits are required to disaggregate the amount of contributed non-financial assets received by category. Some examples of these categories might include supplies, food, and/or clothing. And the following slides contain additional illustrations that continue the earlier illustrations of contributed non-financial assets received by an animal shelter that will give you more of an idea of what appropriate disclosures look like. It is possible that a not-for-profit might not receive a material amount of in-kind contributions, or that they would only have one category. Alternatively, they might have multiple categories and receive minor amounts of various gifts in kind that aren't enough to warrant separate categories and can just be grouped together into an other line in the disaggregation after a not-for-profit has separately detailed the significant categories. This is an area requiring judgment, so it's up to you as you are preparing your financial statements. It goes without saying that the total amount of the disaggregated contributed non-financial assets in the disclosures should tie to the statement of activities line item. The qualitative disclosures for each category include disclosing information about whether the assets were monetized or utilized during the reporting period. If the assets were utilized, a description of the programs or other activities in which those assets were used must be included. If monetized, disclosures will include the not-for-profit's policy for monetizing rather than utilizing in-kind contributions. Additionally, any associated donor restrictions must be disclosed for each category. Organizations must provide a description of the valuation techniques and inputs used to arrive at a fair value measure at initial recognition following guidance in Topic 820. If a recipient not-for-profit is prohibited by donor restrictions from selling or using the contributed non-financial asset in the principal market or the most advantageous market, the not-for-profit must disclose that market that was used to arrive at a fair value measurement. And so for those in the audience who are actually following the GICS project prior to the issuance of the final ASU, it's worth noting that in response to feedback received on the exposure draft, the board actually made various refinements to the proposed disclosure requirements to improve their clarity, operationality, and auditability. For example, instead of requiring that a not-for-profit indicate whether it intended to monetize gifts in kind received as part of the first qualitative disclosure in A, a not-for-profit would only note actual monetization and then describe any policy on monetizing GICS that it may have in place. Also, we clarified that unlike other instances involving disclosure of valuation techniques and inputs under the Topic 820 paragraph cited in Disclosure D, which would only be for subsequent measurements, such disclosure would be required here for initial recognition of gifts in kind. Instead of relying on a not-for-profit identifying whether the principal market is a significant input to be disclosed in connection with the requirement in D, we created a separate requirement in E to more unambiguously add transparency for instances that have been at the heart of regulators' concerns. So now moving on to the next set of slides, I'll walk you through a few disclosures to give you an example of what these disclosure requirements actually look like in practice. Given that the ASU does not dictate a specific format and not all not-for-profits are animal shelters, disclosures in practice may look different than these illustrations, and that's due to the flexibility that really is provided by this requirement. But the illustrations in this presentation and the ASU will hopefully provide at least a helpful reference for you going forward. So the following illustration is a tabular disclosure that contains both the quantitative and qualitative disclosures in one table. So the $528,140 amount of revenues identified in the statement of activities on a previous slide is disaggregated here into three categories: a building, veterinary supplies, and food. And I think we actually got a question earlier on whether or not contributed non-financial assets includes real estate. And this is an example of, yes, it can include real estate. We have a building listed as an example of a category. So you can see that none of the categories of contributed assets were subject to donor-imposed restrictions here, except for the veterinary supplies, of which 15,000 were restricted for the animal rescue program. And I'll also note that just for purposes of keeping this presentation a bit more simple, this is actually an extension of the previous slide. We didn't include this restriction just because to have donor restrictions when you have a category, you'd have to add a lot of extra columns. And so this was just to give you an illustration and an actual disclosure, but you won't actually have seen it earlier in that slide. So this table also discloses the programs that categories of assets were used in, as well as how the assets were valued. For the building, this valuation was on the basis of recent comparable sales prices in the appropriate real estate market, and the supplies and food were valued using wholesale value estimates for similar products. So moving on to the next slide, we have an illustration that it discloses the same exact information. You can see the same three categories and the associated amounts, but this time it's in a narrative format as opposed to a table. And here we've disclosed the valuation techniques and inputs for each category, and then also disclosed the restrictions and utilizations as a separate paragraph. Another approach could have been that you take each category of asset and then make a paragraph for each one in which you include the necessary disclosures. This narrative format is not more or less preferable to the tabular format and really illustrates that there's no one correct format for disclosures required by this ASU. So moving on to the next slide, and continuing with the animal shelter theme, we're actually providing you with a few more nuanced examples of categories and their related disclosures. And I think we're still on the same slide, so if we can go to the next slide. Perfect. So here we have a category of contributed non-financial assets that were actually monetized. And as opposed to the earlier illustrations that disclosed the programs in which the categorized assets were utilized in, the not-for-profit monetized the vehicles in this example that they received. So as a result, they've disclosed both the monetization and the policy of monetizing all contributed vehicles immediately upon receipt unless restricted for use in a specific program. Additionally, they listed that there were no restrictions, which meant that all vehicles were monetized and actual sales prices were what were used for the disclosure amount. You might be wondering what would be the disclosure of a not-for-profit that monetizes in-kind contributions but does not have a monetization policy. Just like this illustration, the not-for-profit would disclose the actual monetization, but then they wouldn't have to disclose a policy if they did not have one. So now moving on to the next slide on contributed services. This actually hopefully will answer one of our other questions that we got of whether or not we include volunteers with specialized skills. Contributed services are unique from other categories of contributed non-financial assets in that there were already disclosures required by Gaap of these services from before the ASU was released. As a result, a not-for-profit might have to make disclosures in addition to the ones required by the ASU for recognized contributed services. The pre-existing requirements include describing the programs or activities for which contributed services were used, including the nature and extent, which can be both non-monetary and monetary information, received for the period and amounts recognized as revenues. Also, not-for-profits are encouraged to disclose the fair value of contributed services received, but not recognized as revenues. And as a reminder, not-for-profits are required to recognize contributed services in the financial statements at fair value if the services either create or enhance a non-financial asset, or they require specialized skills provided by entities or persons possessing such skills, such as someone asked in a question, physicians, attorneys, accountant services. And the organization would also need to otherwise purchase those services if they had not been donated. Thus, recognized contributed services do fall within the scope of the ASU, necessitating disclosure as a category of contributed non-financial assets and the additional qualitative disclosures. Non-recognized contributed services that don't require any specialized skills or enhance a non-financial asset will require additional disclosure that stems from pre-existing guidance. So moving on to the next slide, we actually see an example of this. This is where the animal shelter is actually receiving approximately 13,730 hours of contributed services, of which only 530 hours were recognized. And you'll see that for the 530 hours that were recognized, because they were veterinary skills, which requires specialized skills, they were valued and included in the disaggregation. You can also see that the utilization of the services as well as valuation techniques are also disclosed in accordance with the requirements of the update. In addition to the ASU requirements, there is a disclosure about the 13,200 hours of non-recognized contributed services, which did not require specialized skill or enhance a non-financial asset. And this complies with the requirements that are separate from this ASU. So finally, moving on to the next slide, this is our last illustration of disclosures. And this is an illustration of the last disclosure E that was on our previous list. In this illustration, we have the animal shelter recognizing $11,876 worth of veterinary medicine, or veterinary pharmaceuticals, or animal drugs. Our deep dive into the world of animal shelters has really emphasized that there are often multiple names and labels that can be applicable to a category of non-financial assets. These pharmaceuticals were restricted for use outside of the United States and were ultimately used in rescue operations in the Caribbean. This disclosure meets the restriction and the utilization requirements of the ASU. The next paragraph is an important disclosure of the principal market that was used to value the restricted medicines, which I will go ahead and read. It says, in valuing contributed veterinary medicine otherwise legally permissible for sale in the United States, the not-for-profit used the veterinary fee reference published by the American Animal Hospital Association that approximates wholesale animal drug prices in the United States, that is, the principal market. In valuing veterinary medicine not legally permissible for sale in the United States and primarily consumed in developing markets, the not-for-profit used third-party sources representing wholesale exit prices in the developing markets in which the products are approved for sale. So this illustrates the disclosure of the principal market, or most advantageous market, which in this case, it is the principal market. And that was used to actually arrive at the fair value measurement because it is the market in which the not-for-profit is prohibited by donor restrictions from selling or using the contributed medicines. So now that we've wrapped up our disclosures, I'm going to turn it back over to Liz to take us to another polling question.
Yeah, thanks, Rachel. So I'll turn it over to, our question 4. In a typical year, what non-financial assets do you or your clients receive the most of that are within the scope of ASU 2020-07? A is pharmaceuticals, B is food, C is clothing, D is contributed services, and E is other, and F, which is non-applicable if you don't receive any. So I think while we're waiting for that polling question to go, there are a bunch of questions we got in. I'll start off by addressing a couple of them. So one question we got was, if we choose to adopt early, will we need to restate the year-end 6/30/19 comparative also? So the requirements are retrospective, and so if you're doing presentation, if you do have comparative periods, you would also need to include the breakout of the contributed non-financial assets for the prior period as well for that comparative period.
Liz, I just want to Liz, can I add one thing there?
Yes.
And that is that, and I don't know if the question was getting at this, but you don't have to reissue last year's financials or anything like that. All we're talking about here is just in a comparative year that you present as part of this year's financial statements, you do need to reflect that. So again, I don't know if you were driving at that, but I just wanted to make sure that that was clear.
Yes, right. There's no restatement of prior year periods or amounts, but if you have the comparative periods in the current year and you have last year's in there, you would have to break that out separately as well. Jeff, did you want to touch upon any of the questions that you've got?
Sure. And I was going to, by the way, I was going to apologize for being in the dark here. That power to my house went out. It's always wonderful for that to happen when we're on with 1,000 people. But I've just gotten my power back. I'm now scrambling a little bit to get caught up. But here's one. I'll try to take a couple of quick ones. One question was, should we stop saying gifts in kind? Of course not. You don't have to stop saying gifts in kind. We just, for purposes of the rigor in our standards, refer to contributed non-financial assets. We know that, in common practice, gifts in kind is the typically used term. So go ahead and use that. We're not stopping you from using that. See if there's anything quick. Oh, one more. I'll just do a quick one. So can gifts in kind be included in the restricted column? Yes, very much so. We didn't illustrate that in the examples that Liz went over before, but absolutely it would and could be in a restricted column, because again, if the resource comes in with a donor or grantor restriction, that's how we normally would show it.
Yep. Thanks, Jeff. I'll answer one other one too that's, I think, somewhat quick. Someone had a question around the scope in terms of, does it include volunteer time, donated services, things like that. And so current Gaap, before this ASU went out, does have some guidance around in terms of the recognition and measurement, initial initial recognition and measurement of the contributions and the voluntary type stuff. But this would include, to the extent that things are recognized in your financial statements for contributed services, because I think there are some cases where it may not meet the recognition criteria, those would be included in terms of the presentation and disclosure requirements. So I think before we go on to any other questions, maybe we'll just go over this polling here. And we got some, it looks like most people, so for polling question 4, we have a lot of contributed services. So I guess that was kind of right on point to the question here. We do get a lot, there's people here that do get a lot of contributed services. It looks like other was a big factor. Some people don't get any. And looks like some do get pharmaceuticals and a little bit get food and clothing. So a little bit of a mix here, but looks like a lot of contributed services.
So Liz, can I just ask you a quick question related to that last question you answered? So as it relates to contributed services, step 1 would be to determine whether you meet the recognition and measurement requirements of the Gaap associated with contributed services. And step 2 would be, if you do, then this presentation and disclosure standard applies. Is that right?
Yes, that's correct, Sue. Yep. And there are some other disclosures around contributed services that are not recognized, but that's something that's already was in current Gaap, and that's not part of this ASU. All right, I think maybe we'll move on to the next topic. So I'm going to turn it over to Jeff. He's going to talk us about some fair evaluation questions, which is, not necessarily, we don't go into detail into the ASU, but we have been getting a lot of questions in terms of implementation. So Jeff, I'll turn it over to you now.
Thanks, Liz. And again, it's great to be back in the light here. So let's move on to the next slide. Okay, terrific. So in addition to covering the new ASU on presentation and disclosure, which we've spent this session so far going over, we also want to take the opportunity to give some reminders about applying current Gaap in valuing gifts in kind. Again, this is the valuation piece of it. In the notice to recipients for the exposure draft of the ASU back in February, we did ask whether there were areas of valuation that were especially needed, where there especially needed to be some additional guidance in our educational and other efforts. And there were a few areas that were noted by respondents to the ED. For example, from a respondent who was a preparer, we heard that first, some not-for-profits may not always be properly applying the concept of a principal market, sometimes bypassing that for the most advantageous market instead. And also, even in instances where the appropriate market has been chosen, in selecting and using wholesale price data, sometimes not-for-profits may not be factoring in all of the appropriate discounts that market participants would factor in. And indeed, regulators also raised that latter issue in their letters, not taking appropriate discounts. The preparer, and I'll give a shout out here, it was World Vision, that is a matter of public record in terms of their comment letter, also had some really good suggestions that I'll be passing on to you as part of this part of the presentation. Now, regulators also indicated that in some instances where intermediaries are involved, especially when they're related organizations, there may be some inappropriate recognition of revenues and expenses as opposed to treating these as pass-through transactions. This concern is what's been referred to over the years as a daisy chain issue. Now, in the next several minutes, while I'll be focusing on donated pharmaceuticals, it's important to note that what I'm about to say would apply to other gifts in kind as well. So let's move on to the next slide here. First, let me give you a couple of reminders about fair value measurement. The first one is, most of you or all of you already know this, that the codification says that contributions received have to be measured at their fair value. Now, there are some limited expedients here, mostly with certain low-value gifts in kind, but again, this is the general requirement. And it further states that Topic 820, which is the general framework for fair value measurement, is what should be followed here. Now, that fair value framework in Topic 820 is one that applies well beyond gifts in kind and indeed well beyond not-for-profit organizations to all sorts of transactions involving various types of businesses as well. So the definition, many of you may have memorized this word for word by now, that comes from topic 820, originally statement 157, was that fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Now, there's a lot to unpack there, and I'm not going to try to unpack all of this in this session, but the key point I wanted to make here is that fair value is from the perspective of participants in the appropriate market, which is typically the principal market. I also want to mention, we've gotten some questions over the years about this, that end beneficiaries, those ultimately receiving these goods or services, are typically not market participants. Market participants instead would be other not-for-profits, governments, and other entities that buy and sell these types of assets, typically at wholesale and in bulk. Let's go on to the next slide. Okay, great. The principal market is the market with the greatest volume, which the not-for-profit recipient must have the legal ability generally to access. There could, for example, be licensing, infrastructure, or other general barriers to entry that might keep the not-for-profit out of a market. It's important to note that any restrictions specifically placed on a reporting entity with regard to a particular transaction, here or in other areas of Gaap, wouldn't affect fair value, which is from the perspective of a participant in the principal market. Rather, it would be disclosed, and in the case of not-for-profits, if it emanated from a donor or a grantor, it would also be reflected in the net asset classification. Finally, it's important to note that the most advantageous market is a fallback concept. It only applies when there isn't a clear principal market. So let's get into an example of that. Some not-for-profits may be jumping to incorrect conclusions with regard to principal markets. And I'm going to give you again an example in the pharmaceutical space. I think we can agree that if a drug is approved for use in other countries, but not approved by the Food and Drug Administration, the FDA, for use in the United States, the US clearly isn't the principal market. But that doesn't mean that the inverse is true. Just because something is FDA approved for use in the US doesn't mean that you'd use the US market for evaluation automatically. In their letter, World Vision cites what's the medication that's used for river blindness, to treat river blindness, as an example of something that's treating an illness that's much more prevalent in other parts of the world. Now, I'm not a medical expert or a public health expert, but perhaps malaria and the treatment of malaria might fall into the same bucket. One other example that I remember well is deworming medication for humans, something that we talked about with folks in industry when they were first applying Statement 157, Topic 820 about a decade ago. Now, contrast these, for example, to medication to treat diabetes or cancer or something else that is prevalent in the US. And indeed here, so again, it has to be the market with greatest volume. And I think in that regard, World Vision staff had a pretty good suggestion here. And I think it's pretty good practice to have a rebuttable presumption, or whatever you might want to call it, that a medication that doesn't have much use in the US in that type of a scenario, the US probably isn't the principal market, even if it's approved for use in the US. Let's move on to the next slide. Now, once the appropriate market is identified, then the assumptions that a not-for-profit should use in valuing gifts in kind received should reflect those that market participants would factor into what they'd be willing to pay for the asset. Remember the definition of fair value. It's the price that you'd receive from market participant, from selling the asset to them. These generally wouldn't be list prices, but actual prices in the market reflecting appropriate discounts. Let's move on to pharmaceuticals. Okay, thanks. Pricing of pharmaceuticals is especially complex, and I'm not going to try to wade into it too much here, maybe ankle deep. There are various wholesale price data sources among pharmaceutical pricing indices. There's wholesale acquisition cost, average wholesale price, national average drug acquisition cost, and average manufacturer price, just to name 4 of them. And believe me, there are several more out there as well. From what I understand, some are more reflective than others about actual prices in the marketplace. In our example in the ASU, we use the quote-unquote federal upper limit based on the weighted average of the most recently reported average manufacturer's price, or something like that. Now, keep in mind that that's just a FASB illustration, a hypothetical. It's not meant to substitute for the real-world judgments that are taking place about indexes as well as appropriate discounts. So again, important things to remember. Before I leave the slide, I wanted to remind all of you not to forget to also take into account discounts that would be needed because of the condition of the asset itself. For example, in the area of pharmaceuticals, how close a lot of pharmaceuticals is to its expiration date. Now, let me, before I get on to the third issue that we heard about during our, in response to our exposure draft, let me turn it back to Liz for a polling question.
Yep. Thanks, Jeff. So we're going to turn it on, move to our next polling question. So question 5, true or false, retrospective application is required for ASU 2020-07. A is true and B is false. I think that while we're waiting for those to come up, we can answer some other questions. I know I got a couple that I could answer. So one is, will there also be a requirement to show the expense on a separate line item too? So there is no requirement to actually separately break out the expense side. What we've heard from stakeholders is that can be really challenging to break out, especially if there are in-kind contributions that are used, in the same period versus, what you've received, what you've used versus what you haven't gotten from in-kind. So I think what the board decided to do was rather than have you separately break those out, that there are some qualitative disclosure around the type of expenses that you're having. And then also another question was, does presentation have to be on the face of the income statement? So the requirement for presentation in terms of breaking out the contributed non-financial assets separately, apart from cash or other financial assets, is the requirement for the presentation on the statement of your on your main financial statements. That is not a disclosure requirement. That is a presentation requirement.
Yeah.
Jeff, did you want to add something there?
Yeah, the only thing I would add is, again, obviously materiality comes into play. I think you made that point earlier, as with anything else in Gaap. But if this is at all material, it needs to be a separate line item at a minimum in the statement of activities. Earlier, Liz gave you examples of beyond the revenue side. Some might put it into a whole separate column or a whole separate section of the schedule of functional or statement of functional expenses that would also incorporate the expense side. But again, that's just best practice and going beyond what's the requirement. But the minimum requirement is a separate presentation in the revenue section that comes, or the activity statement of the not-for-profit.
Yeah, and we did actually get some questions, Jeff, to that point around materiality. So we're not, this ASU does not prescribe how you would determine materiality. That would be done as you determine materiality throughout your audit, as you would in the normal, how you'd normally been doing in the past. We're not prescribing how to determine materiality, but if you conclude that there is, contributed non-financial assets that are not material, you could still always choose to present it separately if you wanted, or disclose it if you wanted, but there would be no requirement to do that.
That's right.
Okay, so then we have, polling question 5, looks like most of you said A, true. So that's right, the requirements are retrospective applications. So with that, I'll just turn it back over to Jeff to go through the rest.
Thanks, Liz.
Unless you wanted to answer any other questions first.
We will have time, after this session, this part of the session to do so. Okay, thank you. All right, so in their letters, let me move on to the third issue. As I mentioned earlier, regulators also cited daisy chain concerns about intermediaries. This is an issue that we heard about when the sector was first implementing Statement 157, now Topic 820, about a decade ago. Indeed, a subgroup of the FASB's Not-for-Profit Advisory Committee, its NAC, including members from industry and public accounting and our representative from the regulatory community, looked at this along with the FASB staff, again, about a decade ago, and concluded that the guidance, which originally stemmed from Statement 136, which was issued in 1999, and all that's still now codified in subtopic 98605. Anyway, that guidance was sound guidance. In other words, this wasn't an issue having to do with the guidance. This was an issue that had to do with compliance, with actually applying the guidance appropriately. So to the extent that this is still an issue, let me remind all of you about what Gaap is here. So let me go through this. So in order for an intermediary or recipient to recognize revenue and expenses here, rather than this be a pass-through, just a balance sheet only transaction, the not-for-profit recipient has to have a discretion, has to have variance power in using or distributing the gifts in kind, especially in cases where the donor or the grantor had specified particular beneficiaries. And in practice, variance power is sometimes described as the unilateral ability to redirect such assets, such benefits. And the not-for-profit also has to have the risks and rewards of ownership over these gifts in kind, such as the risk of loss if they're lost, damaged, or destroyed, as well as the ability to obtain the benefits of and control others' access to the gifts in kind. And that typically happens through typically involves taking physical possession, but sometimes instead there's constructive possession, such as when these assets are housed in a third-party warehouse. Let's go on to the next slide. Couple of reminders about, sorry about that. So we have here is a couple of contrasting scenarios to drive home this point. In the first scenario, a donor contributes $100,000 in pharmaceuticals to a not-for-profit to deploy to several named organizations that are fighting malaria in a country. However, the donor explicitly grants the not-for-profit the unilateral right to redirect to those pharmaceuticals to other organizations, other beneficiaries, if the not-for-profit sees a greater need in another region. Not-for-profit has the risks and rewards of ownership that's part of this fact pattern having to do with the contributed pharmaceuticals. Now, in this particular case, a not-for-profit would recognize the pharmaceuticals as an asset as well as contribution revenue of $100,000. And then, when it distributes that, there'd also be an expense associated with that because the not-for-profit has variance power as well as the risks and rewards of ownership. Contrast that with our scenario B. A donor contributes $100,000 of pharmaceuticals to a not-for-profit to transfer to several named organizations, beneficiaries, that are fighting malaria in a country. Now, that's the same. Not-for-profit does not have variance power. And again, assume it has the risks and rewards of ownership. Now, in this particular case, a not-for-profit would recognize an asset, but it would on the other side of it would recognize a corresponding liability, would not recognize revenue and then later on expenses. It would, when these are distributed, it wouldn't be an expense, it would just be a reduction of the liability. And it does so because the not-for-profit does not have the discretion to choose the beneficiary and therefore is acting more as an agent. Now, on the other hand, if the donor did not specify that the beneficiary, sorry, not reading well, and broadly noted that the pharmaceuticals must be used to fight malaria in that country, the pharmaceuticals would still be considered a contribution since the entity could then choose the beneficiaries. So again, this is only in situations where an organization has the ability to either choose or to redirect to beneficiaries. It isn't just passing it through to named beneficiaries. Okay. Let me go through one more slide in this section, and that's just to give you a couple of reminders about intermediary organizations, especially to the extent that they are related organizations. So there, it's important to note that the codification says that fair value would generally not increase when a gift in kind is passed from one entity to another. However, fair value could increase if the entity adds value to the gift, such as cleaning and packaging the gift. Any increases should be evaluated to determine whether the entity did, in fact, add to the fair value of the gift. And indeed, even beyond these gifts in kind situations, in a letter, the charities regulators cite instances of pharmaceuticals being purchased inexpensively in Europe and then somehow being valued at much higher U.S. prices. And indeed, Sue Cosper and I heard of a similar instance when we were meeting face-to-face with regulators a couple of years ago. Now, I don't know all of the details that may be involved here, but that may very well have not been appropriate under Gaap. The other thing that I wanted to stress here is the second point here, and that is that there are related party disclosures that may be required here, under topic 850 in Gaap, for affiliates. Sorry, there's a few extra words there for affiliates and other related entities, and it's possible that these could even be fairly extensive disclosures depending on the nature of the transaction. So with that, that concludes the third issue that I wanted to cover, and I wanted to turn it back, I guess, to Liz here.
Yeah, thanks, Jeff. So we do have one final polling question. But before we do that, I think what we'll do is we'll just touch base on, I mentioned earlier in the presentation that we were going to have implementation resources. And so after this webcast, there's an implementation page on the FASB website where we have non-for-profit activities, and we are going to put a link to the ASU, a link to this webcast, and some helpful information there for you guys in terms of looking at implementation resources that are available. And we also wanted to mention that we do have a technical inquiry service. So I know we did get a lot of questions today. We're gonna try and answer as many as we can. But we also wanted to recognize that we do have a technical inquiry service. So if you have very specific fact patterns that you would like to get some input on, or if we don't get to some of your questions today, we also have that available as well as you're going through this and implementing guidance. So with that, I think that maybe we can move on to a couple of polling questions first, and then, before we get to the last polling question, I think we can probably wait until the end to do that one. So I do have some questions that I know I can address right now, and then maybe I'll just turn it over to, Jeff and others, or Sue. I think Sue has a couple too, and we can try and get some of these questions addressed.
Yeah. Liz, before you answer that, I want to say that there are a lot of very detailed questions about specific fact patterns having to do with valuing gifts in kind. I mean, I think in many cases, it's probably best off to try to answer some of those offline afterwards directly with the person who's asking. Here, I'd like to focus, if we could, more on general questions. Yeah.
So one question I had is, I think this was related to some of the examples we did for a presentation, is how could the revenue be higher than the expense column? And I think that, one of the reasons could be, based on what's utilized. So, they could be getting gifts in kind, and maybe they're not utilizing them all in one particular year. So the revenue and the expenses don't necessarily have to match up. So that's one question I had. Jeff, you want to maybe answer another one?
Yeah, let me see. I'm trying to scroll through a bunch of these here.
Yeah.
Yeah, so many of these are like detailed, fact.
Yeah, I can go ahead while you're looking through them.
Let me sorry, go ahead, Liz.
Oh, go ahead. I just had a quick one here about a food bank. The question was, that they call it donated food on their financials. So would food for a food bank, be required to do the presentation and disclosure? So yes, food would be included in the scope. You don't necessarily need to call it in kind. You can keep calling it food, donated food, if that's what you're calling it. So I'm not exactly sure if the question is about whether you need to call it food or not, but it would be in scope, and you don't need to call it food, but you certainly can if that's how you're doing it now.
Okay. This one has to do with valuation, but it is a sort of general question that we've certainly talked about over the years, which is has to do with restrictions on an asset as opposed to an entity. And here's the question: how would a not-for-profit go about valuing donated land if there is a conservation easement? Wouldn't much of the value to the general public wouldn't have much value to the general public with the easement attached? I know there are those who, well, first of all, you would have to factor that in. If it is an easement that gets written essentially into the deed for the land, that really becomes a characteristic of the land itself, and therefore, under the fair value framework, the restriction would be taken into account by any subsequent, even hypothetical holder of such land. That absolutely would be taken into account. There are folks who specialize in valuing land with these types of easements, I guess with and without the easement. And, I know that there are organizations such as, there are major environmental organizations that probably use such valuation experts all the time. So again, it would be something that would be factored in.
So Jeff, I have a question that is kind of interesting.
Yeah.
Which is, would this also include in-kind rents on a building?
Yeah.
And I think this is an interesting question because I think it depends on the way the contribution is structured. So, for example, are they providing them cash to pay the rent, or are they actually providing them the use of the building? And so, certainly I'd like your opinion, Jeff, but I think that if it's the use of the building, then it seems to me that it would qualify in this circumstance.
Yeah, and I'm
not
even going
to pay the rent. No.
Agree, Sue. And remember, when we look in that first slide, when we talk about the scope of this, it's fixed assets and the use of fixed assets. So the use of space or some other asset would certainly fall under this. And there'd be a separate presentation and disclosure. Now, one of the interesting things, I'll just digress for a second, that we've been asked here is if it's free rent, does this fall under the new leases standard, which, as you may recall, would cause you normally to capitalize a liability and a corresponding right of use asset? The answer is, if this is free rent, it would be no, because it wouldn't meet the definition of a lease. It's not the right to use an asset in return for consideration. There's no consideration. Now, I'll tell you that in practice, an organization would record the revenue, and again, this would be separately disclosed or separately presented, and there'd be some disclosure around it. And then the question is, what's the debit? And I think in practice, the debit has traditionally been, well, some have put it up as a type of fixed asset. Others have put it up as a type of pledge or contribution receivable. I think with the general notion now of a right of use asset, with leases, this thing on the balance sheet, there may be a little bit more standardization going forward as to what the debit to this is, the asset. But the credit would be to contribution, and wouldn't technically be under the leases standard, though. Sue, did you get any other really interesting questions?
I think a couple of the other ones are around items that we've talked about, which is really just to emphasize that you have to adopt the standard in a retrospective transition methodology, which means you do have to change your presentation in prior years, not restate your financial statements, not reissue them, but when you present it the same way that you do as you adopt the standard. So if you disaggregate it in the year you adopt, then you would disaggregate the prior period as well.
So here's one. Contributed non-financial assets is the requirement for the presentation. Is a preparer prohibited from including stock gifts in that line to show all gifts together if they disclose the components, or must the non-financial be completely separate in display? Look, again, that's certainly a judgment call in materiality, but when we mean non-financial assets, we really do mean non-financial assets. So I don't know if it's how awkward it might be to do a total of the two on the statement of activities, or maybe that's something you present in the notes, but a stock gift does need to be separate from a gift of a non-financial asset.
Yeah, Jeff, just to touch on that point, I did get some questions assigned to me as well about, whether or not donated stock or stock options would be a non-financial asset for this purpose. So that you sort of answered that in your response there, that they would need to be separately, separate from what we're doing here with this contributed non-financial assets. And I also did have a couple questions actually related to the rent question that Sue had around, what are the requirements around donated rent in light of the upcoming leases standard, and would you recognize donated rent versus it as income and expense, or required to be as a right of use asset and lease liability? So I think Sue touched upon, kind of you have to look a little bit deeper in terms of what it is that you're actually receiving to kind of go through that exercise, but some other related questions on those topics.
Yeah. So here's one that was sent to me, and again, I don't know the full context, I don't know which particular example they're referring to, but it said, the question is, so is the wholesale value in your example anticipated to approximate an exit transaction value? Again, what would, we're talking about wholesale values because typically a not-for-profit would not have access to a retail market to sell these kinds of things. And even if they did, you'd have to then be also factoring in the additional costs to sell these that might be entailed in terms of going to retail there. But so it's probably a wholesale price. But in terms of wholesale exit value, remember those things I stressed before. It does need to have incorporate appropriate discounts to reflect what would be more actual transactions, what market participants would expect in terms of what they would pay for these particular assets, not just like a list price or something like that.
We did get some questions related to collections and how this relates to things that are put as collections on the balance sheet. So one question is, do the disclosure requirements apply to non-recognized assets other than services? So things like, gifts of art to a museum that does not, where you wouldn't recognize it on the balance sheet. Jeff, I don't know if you maybe want to touch upon some of the changes that you made in the definition of a collection or things like that. But
well, that has to do with sale of items and purchase of other items and so on. But here we're talking about an actual gift. And I wish I had my museum expert, Rick Cole, still with me, who probably could answer this off the top of his head. But to the extent that there is revenue recognized here, and I can't off the top of my head remember if you recognize it and then de-recognize it down below, or you just don't recognize it at all. Sorry, I'm winging it just a little there. But if you're recognizing the revenue and it involves a non-financial asset, which is collection item is going to be, then you would have some disclosures around it, but you'd indicate that you de-accessed it and put it into the collection. But again, I'm stretching that just a little bit because I don't remember offhand if you recognize it and de-recognize it immediately, or if you don't recognize it at all and just disclose it.
Jeff, there's a couple on rents, back to the leasing interaction.
Yep.
And, whether it's a discounted lease contract. So in other words, you get free rent for a couple of months, but then you have a contract that kicks in. And so,
okay.
Not to get into the specifics, because I think that some of these are very specific, but I guess the general observation would be that you need to look at the leasing standard because there's very specific guidance on a period where there's free rent or a period where there's discounted rent, but then you have an associated lease contract that goes out, 5 years or whatever. So, certainly we'd be happy to entertain that, in a technical inquiry if somebody wants to talk more specifics about that.
But I think it's important to distinguish here, Sue, between free rent that is part of a regular business transaction that they would give any lessee in the current economic environment for leasing, versus one that really is meant as a contribution for a period of time. And that's maybe not an easy judgment to make. We get some similar judgments that need to be made as to when something is a below market lease versus when there is actually really an inherent contribution in it. And again, not an easy judgment call.
Agree.
So any other general questions here? Again, I know there was a lot of detailed specific questions. We'll find a way to get back to folks who asked those, but just wanted to see Rachel or Sue or Liz, did you see any other real general ones we could ask here?
I can jump in with one last. Oh,
go ahead, Rachel.
Or Liz.
Sue, I'll let you go.
I think Rachel wanted to go. I didn't say anything.
Okay, I'll take a stab at it.
Rachel, go ahead.
Sorry, Liz. We did get a question about whether when recording donated services, if they still have to meet the qualifications of an organization purchasing them if not donated, and if they are services that require a specialized skill. And that's already in the guidance. The ASU did nothing to change that. So the contributed services that you would recognize still stay the same. The requirements are still the same of either they must require a specialized skill or they enhance a non-financial asset, and the organization would have purchased them if not donated.
Yeah, as you say, we didn't change the existing requirements. All we did was add to them so that they're consistent with the other non-financial assets in this new ASU. Here's one that has to do with an example I gave towards the end. In the malaria example for $100,000, when the NFP does record the revenue, if it should, would that be donor restricted revenue, assuming the gift is more narrow in scope than the general mission of the organization? Yeah, and it would be a type of purpose restriction if this is narrower than the overall mission of the organization, and it could very well be. And again, the donor has to restrict it, the grantor has to restrict it. This is not an internal decision to do it or something like that.
Yeah, and then there was one question I got related to contributed services in terms of what you would need to disclose if it's not recognized. And so there is a disclosure requirement in 958-605 right now about contributed services that was there prior to this ASU. And it just talks about, it's actually 958-605 50-1B. And it talks about, it says that entities are encouraged to disclose contributed services received but not recognized as revenues if it's practicable. And so things that you could disclose would be things like the nature and extent of the contributed services received, and then it goes on to say can be described by non-monetary information such as the number and trends of donated hours received or service outputs provided by volunteer efforts, or other monetary information such as the dollar amount of contributions raised by volunteers. Disclosure of contributed services is required regardless of whether the services received are recognized as revenue in the financial statement. So you can look to that one disclosure requirement there. It gives you some guidance around in terms of when you don't recognize something, what you could consider for disclosure.
Yeah, and one of the examples Rachel went over with the animal shelter, I think she had one of those slides had a little bit of that type of information.
Yep. All right. Well, I think we're nearing to the end here, so I'll just go ahead and ask that last polling question now, and then so question 6, which is yes or no, is your organization prepared to implement or audit ASU 2020-07? So we'll wait to see what people say. We hope that they all say A, yes, B, no, C, NA, or D, I'm not sure.
And maybe they're at least a little better prepared, after this webcast. Obviously.
Ooh, we got a good so far.
And Liz, I just, one of the participants was kind enough to remind us that there is an AICPA white paper on the interaction between contributed spaces and the leasing guidance as well. So
terrific.
Thanks for that reminder.
Yeah.
Thanks.
Yeah, the AICPA has a lot of great information in terms of implementation of these types of questions we're getting in as well. So that is a good reminder. Well, I know, like as Jeff mentioned, we did, I guess while we're waiting. Okay, poll has ended. So, all right. mostly everybody is ready, so that's good news. We do have, if you have any questions going forward, as we mentioned, please, you can either reach out to myself or, any of the team members, project team members, or the technical inquiry service is great because it helps to keep track of the questions we're getting in so that we make sure that we are, consistent in responding to stakeholders when they have these questions, and help us keep track of what the issues are that people are facing in practice when implementing the guidance. So with that, I guess we'll just see. I just want to thank everybody for joining, and we had great participation today. This will be available on Webcast, on archive. I'll just see if anyone else has any last few things to say, Sue or Jeff. Just if you guys have anything, but really just want to thank everybody for all the questions. It sounds like people are really engaged in this, and we'll do our best to kind of go through them and make sure we respond back.
Liz, as a housekeeping matter, I know we've gotten a couple of questions on whether folks can download the slides.
Should be able to, right?
Yeah, I think so, but I just wanted to confirm that.
Liz, yeah, I think you mentioned early on in the events resources tab or something like that.
Yes, so on the left-hand side of the screen, there should be an events resources tab that you can click on to download the slides. If you're having any issues getting the slides, you can always send me an email, after the webcast, and we can get those over to you.
Yeah, I guess the only other thing to say here, Liz, is just remind people to fill out the survey. We'd love to have your feedback on this. And again, good luck on implementing this, and we're there to help in any way that we can. Yep,
great. All right, well, thank you, everybody. And thanks everyone that was presenting today. You all, they all did a lot of hard work getting materials ready, and thanks for all the participants. And have a great rest of your day.
Thank you, guys.